The Money Show. Personal finance.
Welcome to The Money Show. Warren Ingram from Galileo Capital standing by. Such a cool fact from the agricultural economist Wandile Sehlobo today. 31% of the wheat we consume in South Africa is imported. And if you think of it as a regular loaf of bread, and every loaf of bread, if you get them sliced at a normal sort of thickness, has about 21 slices. So it's the equivalent of 8 of every 21 slices of bread consumed in South Africa is imported. It's a useless but interesting fact. Now, where do we invest money? Warning. On to back to the point. Sorry, I find that sort of trivia interesting. All right.
I was waiting for something. I wasn't sure where you were going with that.
I'm just loafing.
Let's slice and dice this. Okay.
Overseas money. Not everybody's got overseas money, and I'm wondering if the point you're trying to make tonight is that you don't really need overseas money, or if you have overseas money, you don't necessarily need it to take it to the place where the usual suspects are in terms of offshore investment. But you tell it.
Gee, that's a great point. I should have thought of that. Oh. So I think a couple of things. One, I'm getting increasingly worried about America, and not because of their outstanding, tongue-in-cheek, of course, but outstanding president. It's more from a pure sort of financial physics point of view. In other words, their stock market is getting increasingly expensive all the time, and it is the world's biggest stock market, and at the moment, it's not priced for fantastic returns in the next 5 or 8 years. It's priced for rather mundane and potentially some scary returns in the next 5 or 8 years. And so, for people that are looking for diversification, and trying to kind of manage the risk of their money, and just sort of sending money out of South Africa because we've got a particularly kind of politically sensitive time at the moment. If they're piling it into America because they think that's a safe place for their money, they might just be jumping out of the proverbial frying pan into the fire. And that's really the point, is where do you go with your money to spread your risks and to find good diversification. And to me, we actually have to look very closely at emerging markets as a starting point.
Okay, but we are in emerging market as it is. So how much further afield do we have to look?
I think we have to go quite far because, South Africa, if you had to take the world of emerging markets and say, well, how big is South Africa in the context just of emerging markets? Well, we're probably smaller than most people would think. I mean, it's certainly a lot less than 10% of the value of the world's emerging stock markets. And so, if you want to be in a nice spread of emerging markets, just having exposure to South Africa, unfortunately, isn't enough. You need to look at, places like, India and China with their major populations and incredible productivity. And then, going right through South Korea, Vietnam, and certain South American countries as well. So you need to go far and wide, I'm afraid.
The vast majority of us can't keep up with what's going on the JSE. Never mind, we're trying to decipher what's going on in Vietnam, to choose one of the destinations you mentioned. So how then does an ordinary human being with a job and maybe some hobbies and a personal life actually get your head around this very different diversification which you're advocating?
I think there are a couple of ways of doing that. So one of them is, you can take the time and do your homework on a few big companies that operate in emerging markets, and I think there's some merit in that, but I think again the risks would be quite severe. So for example, if we just look at the roller coaster ride that investors have with a business like Naspers, which is if you look at the price of Naspers, it's really priced as a sort of a Chinese internet business. You could do the same and say, well, let me find then an Indian bank and a Russian oil company, etc. But I think the risks are very high, and you're going to spend quite a lot of time doing a lot of homework there. So there are a couple of ways. One, look for an index, that gives you that exposure. So the index providers out there, there's one called the MSCI, World Emerging Markets Index, and that's very simple. You don't need to do anything. It's there.
I mean, we should be familiar with the MSCI World Index, which is an index of the world's biggest companies, but this is a World Emerging Markets Index. So in there will be a proportion of South Africa, a proportion of India, a proportion of Brazil, a proportion of Turkey, a proportion of Russia and China.
Correct. Sorry, and I said that badly. It's not. It was me. Not MSCI World Emerging Markets, just MSCI Emerging Markets Index. And just now, people are going to tell us we're talking nonsense. They can't find it. Correct. So they would have exposure to all of those countries, and in fact, then the biggest companies in those different countries. And it's one package, and there you go. And if you think that's either scary or boring, and I'll come back to why that might be scary. That then go and look at the unit trust world. There are going to be literally hundreds of unit trusts that only invest in emerging markets, and I think I mean it's I always sound like a stuck record with my fascination for index investing, but it is the one time where I think you might want to pay actually a bit of extra money to choose a unit trust manager, and the reason why I say that Bruce has fallen off his chair.
Sorry. Could you just repeat that?
I said it's fantastic weather today. So the reason why you might want to consider paying
a human being who charges fees, and you're willing to pay them some money to invest on your behalf.
Absolutely,
you're going soft.
I'm going soft or soft in the head. I'm not sure. I think the reason is if we look at a place like Vietnam as an example, very nice emerging market, great demographics, great economy, very productive population. The problem is that if you look at their stock market and you just bought the index, it consists of a lot of companies that used to be parastatals that are now listed, and unfortunately not the most efficient businesses out there. So you actually in an instance like that, you actually want to pay somebody who understands the Vietnamese stock market very well to actually go and go in. And that's the problem with the emerging markets. There's huge skepticism, for example, about China's stock market. And, do you just buy the Chinese stock market index, which you can do, but a lot of the time people believe that that there's sort of quite a lot of creative accounting in the way that those companies do their books, and so I'd be quite comfortable to pay an expert in that market, and I think that's where I'd like to to actually pay someone to do that, and that means just an emerging market fund manager or two or three.
Now, the question that sort of leaps to mind is if the United States is overvalued and if we're heading into a potentially dangerous era for markets in a lower than expected growth environment and where the returns aren't that spectacular, if the US does suffer a fizzle or a fall, emerging markets are usually the first place to actually take a nosedive. And usually what happens in that sort of scenario is that there's this flight to perceived quality, which is away from emerging markets. So you almost get a double downside whammy, don't you?
It's a fair point, and I think if the US market takes a knock, so it takes a drop, and I think 2008 provided a great example of that. Everybody got the flu that the US gave us, and that's true. Then you don't get diversification from that. But I think if the US goes into a period of just stagnation, and we've lived through that now as South Africa in the last 3.5 years, then there is going to be a flight to growth, in fact, as opposed to a flight away, a flight to quality, and so I think if you just look at the value of emerging market economies as a percentage of the world's economic value now, emerging markets make up 40% of the world's economy already, and that number is only growing. So at some point you might find if you look at the demographics of Europe and you look at the demographics of China, of Japan, and even the US to some extent, their populations are either stagnant or declining, and so you want to actually be in a situation where you've got countries that are growing and extremely productive populations, and at some point investing in their companies that are doing well will then reward you. So I think it is a balance, and certainly not saying please jump out of America altogether and only go into emerging markets. You need to have a good spread.
There we go. Warren Ingram with a good spread. Galileo Capital's Warren Ingram, financial advisor. He's a director at Galileo Capital, and he joins us most Thursdays to talk about personal finance.